Good afternoon. Hong Kong-listed technology stocks led the declines amongst Chinese shares as investors weighed recent gains against an upswing in COVID-19 infections. Mainland benchmarks managed to eke out small gains in the face of lockdown-like restrictions affecting parts of Beijing. Meanwhile, oil is headed for a third weekly loss as the European Union weighs a higher-than-expected price cap on flows of Russian crude and a slowdown in terms of concerns around the outlook when it comes to the energy demand. Meanwhile, locally high-end food and clothes retailer Woolworths will become the 18th company from the JSE's top 40 to list on the A2X. The listing of Woolworths, whose brands include David Jones and Country Road, means that there will now be 91 companies with a combined market capitalization of 5.2 trillion rand on the A2X. And poultry group Quantum Foods reported sobering annual results after it faced a variety of challenges, some of which will continue into the new financial year. To talk to us about the latest when it comes to the markets and, of course, look back at the week that was, we are joined by Martin Smith, who's a portfolio manager at Anchor Capital. Martin, thank you so much for your time. I can't say it's been an eventful week, given the fact that it's been shortened trading week with US Thanksgiving, as well as, I suppose, also shortened trade today with the Black Friday. But when you look back at the week that was, key themes that stood out for you?
I think the biggest thing is essentially has been CPI from the local market and how that's filtered through into our NPC's decision yesterday. Also, we had some dovish comments out of the Fed minutes earlier this week. And I suppose the last thing is creeping concerns around China and COVID cases kind of ticking up there. Got quite a lot of Beijing being shut down now, locked down on the back of that. So I would say interest rates, inflation, and COVID rearing its head in China. That's kind of been keeping the market interested, I guess.
Speaking of interest rates, yesterday we had the Reserve Bank interest rate announcement. How do you gauge the market reaction to that, given the fact that when you look at the rand, there wasn't really much of a movement, given, I suppose, maybe because it was expected that we would see that particular rate increase?
Completely agree with you. It was expected. So everything was in the price. I think people were hoping on a personal level that it would only be 50 basis points, obviously kind of given growth constraints and constrained consumer here in South Africa. But 75 was the number that was in everyone's forecasts. So that came in. You didn't see the rand move. You saw bonds move a little bit and then kind of retrace. So very much in the price. And we did see the big move happen in the kind of preceding day on the back of, like I mentioned earlier,
Given the fact that we've heard so many of the Fed comments, whether it's Lael Brainard or Raphael Bostic or some of the other Fed presidents, what are some of the questions you're asking yourself ahead of the December 14th Fed meeting?
So I suppose it comes that meeting. So I think the market's now pricing in a 50 basis point move as opposed to the 75 that it was a couple of weeks ago. But I think the biggest things leading up to that will be the next jobs numbers that we get and the next CPI print that we get. Those two come before the next Fed meeting, and I think those will be very, very interesting to see what happens there, because I think that'll be quite a big contributor to what the Fed actually does mid-December.
Speaking of what the Fed actually does, what signals and cues are you reading from the bond market right now?
So, I mean, a bond market, the traditional sense of a recession, or this traditional signal, is an inverted yield curve. And that's what we have. Recession at the moment. Equity market, probably not as much. I think there's still a few uncertainties and things there. But I think that's the kind of cue that I'm taking from the bond market, is that they think there's a recession coming, and they think the Fed will continue with its path for now.
Martin, let's leave it there. Thank you so much for your time. That is Martin Smith from Anchor Capital, giving us his perspective on the markets, especially looking back at the week that was. And what we are seeing right now, 10-year Treasury yield dipping around 3.6%. This is on its return after that Thanksgiving holiday. Well, that is it from me. When we come back, we'll have SME on point, so stay tuned for that.